I think that probability actually has increased. I think a few weeks ago, investors would have been pretty concerned about the idea of taper because I don't think the data really gave them comfort that the economy was at escape velocity. But I think, with Friday's jobs report and some of the other ones we've had recently, I think investors are getting comfortable if it does happen in December. Our economists are basically saying the Fed is probably interested in trying to, begin the taper process. I think January is a better date for that. And, we'll have a few more reports. I think we'll have another labor report. I think that's going to help. I think if we can see pretty good Christmas spending through the holidays, that's also going to be a factor. I think investors are still going to kind of want to finish the year strong. I think they're optimistic about 2014. There's still a bit of performance chasing, I think, taking place. And then our position data that we track pretty closely, which looks at hedge fund and mutual fund beta and broader macro fund positioning, shows investors are taking off risk. And that's usually a contrarian bull indicator.
Well, I think there are several. First, I think the reason it's taken so long is that there are 5 agencies, each required to adopt their own version of the Volcker rule. They had to agree, and that's always a hard thing to do. Then I think this charted some very new territory and has led to a great deal of complexity. And third, the initial rule proposal really raised more questions than it responded to. But as to the new features, I think we're going to see more restriction on hedging portfolios. We're going to see greater restrictions on what constitutes proprietary trading, which is not clear. And it has been rumored that there will be a CEO certification requirement, something akin to what I did at the SEC in 2002.
It seems that, part of it was to do with that, and there's also some talks about, corporate capex not being as vibrant as some people have been hoping for. But if you actually look at the bigger picture, the yen's been weakening really over the last year. We're really seeing the impact of the weaker yen coming through over the next, I think, 2 quarters. I think we're going to see much more capital expenditure coming through. We've seen the bank loans have been improving. I think if you provide some reform for taxation that would allow some tax credits for corporate capex, I think we're going to see more improvements there. So we're not really seeing this as an indicator that the economy is slowing down.
But what's actually interesting for the outlook is the reaction in the market and the fact that the yen weakened, which is exactly what the Japanese economy needs. And what was interesting in the first 6 months when we had these strong GDP numbers, we saw the yen actually strengthen. And now the opposite dynamic comes back into play. So I think the weakness right now is more payback for some of the strength we saw in the first half of the year.